Welcome to the channel and thank you for choosing to watch this video. My name is Jonathan and I work in the offshore global business industry. In this video, we will cover offshore financial centers, or OFCs, not to be confused with international financial centers, which will be covered in the next video. First, we will explore and dissect the meaning of the word offshore. Second, we will define what an OFC is by going over its core definition. Third, we will touch upon the perceived association between OFCs and tax havens. Fourth, we will examine the differences between Conduit and Sync OFCs. And finally, we will go through the list of established, accepted, and recognized offshore financial centers. I hope you enjoyed this video and wish you a reflective and insightful viewing. Let's first look at the basic definition of the term offshore in the context of the global financial industry. A couple of definitions of the word itself, provided by the Cambridge Dictionary, stipulate that it means in the first instance, quote, companies or banks based in a different country with different tax rules that cost less money, end quote. In the second definition, it makes reference to basing a business or part of a business in, quote, a different country because it is cheaper, end quote. Taking it further, and whilst keeping the definition we just went over in mind, the term offshore pertains to a geographic location situated outside an individual's or company's home country. It finds prominent usage in the realms of banking and finance, where it denotes regions governed by distinct regulations compared to the home country. These offshore locations are typically, but not only, found in island nations and serve as hubs for establishing corporations, making investments, and storing deposits. Companies and high net worth individuals often opt to relocate offshore to benefit from more advantageous conditions, such as tax mitigation, lenient regulatory frameworks, and asset safeguarding. It is crucial to note that while offshore institutions can be utilized for dubious purposes, they themselves are not inherently unlawful. The notion of engaging in offshore activities sparks a moral discussion on whether seeking financial advantages, notably through lower taxes in foreign jurisdictions, rather than paying higher taxes in one's home country, is ethically sound. It is important to clarify that utilizing offshore jurisdictions for legitimate purposes, as long as there is no involvement in criminal activities like money laundering and terrorist financing, and as long as all relevant laws and regulations are diligently followed, is entirely lawful and aligns with internationally accepted standards. In April 2007, Ahmed Zoromé wrote a working paper for the International Monetary Fund entitled Concept of Offshore Financial Centers, in search of an operational definition. In this paper, Mr. Zoromé defines an OFC as, quote, a country or jurisdiction that provides financial services to non-residents on a scale that is incommensurate with the size and the financing of its economy, end quote. The term incommensurate in reference to the quoted definition means disproportionate. Prior to publishing the IMF working paper, the existing definitions of offshore financial centers lacked a comprehensive understanding of the core aspect that defined the OFC phenomenon, which is the primary purpose of offering financial services to non-residents, essentially exporting financial services. While it can be argued that most economies to some degree provide financial services, what sets OFCs apart is their distinct specialization in delivering financial services on a scale that greatly surpasses the demands and economic size of their own territories. The quoted definition of an OFC provided by Mr. Zoromé subsequently sought to encompass this distinctive feature that categorizes OFCs. The establishment of offshore financial centers is generally driven by various motives, such as local expertise, favorable taxation, and relaxed regulations. These centers are deliberately designed to specialize their economies in providing financial services to non-residents, leading to a significant source of national income. The revenue generated from these financial services offered to non-residents comprises two main components. Firstly, financial services charged to non-residents by entities operating in the offshore jurisdiction. These services include bank fees for advisory and financial engineering, intermediary services fees, for example credit lines, financial leasing, and foreign exchange, commissions related to fund administration and securities transactions, in as such brokerage, placements of issues, underwritings, swaps, options, and hedging instruments, services related to asset management and security custody services, amongst others. Secondly, registration and renewal of fees paid by licensed entities in the offshore jurisdictions. These entities encompass offshore banks, insurance companies, collective investment schemes, international business companies, trusts, and estates, among others. In summary, the establishment and operation of OFCs are categorized by a strategic focus on exporting financial services to non-residents, leading to a significant contribution to their respective national incomes. In July 2007, the Tax Justice Network released a briefing paper entitled Identifying Tax Havens and Offshore Finance Centres. Features on tax havens provided by this briefing paper state that, quote, tax havens and OFCs are closely related, although not every jurisdiction would fall into both categories. They are also similar in that while almost any jurisdiction can have some tax haven or OFC features, a smaller number are usually identified as pure tax havens or OFCs, end quote. The briefing paper further highlights that a haven, whether a pure tax haven or an offshore financial center, is characterized by its ability to utilize laws and measures to evade or avoid tax regulations in other jurisdictions. The core of such havens revolves around minimizing tax liabilities, which is achieved through the use of paper or shell companies, trusts, and legal entities, along with carefully routing and managing financial flows. The interconnection between tax and financial management is integral to their functioning. Pure tax havens or OFCs typically possess laws explicitly tailored for these purposes, attracting financial and corporate services business that constitutes a significant portion of their economies. Their allure stems from their commitment to maintaining secrecy, achieved through strong bank secrecy, where information is not easily accessible by authorities for purposes like tax collection and confidentiality surrounding legal entities such as companies, corporations, trusts, and foundations. This confidentiality extends to details about beneficial owners, persons with control over asset utilization, and financial accounts. Furthermore, these havens often offer specific advantages, particularly a zero or low tax rate, specifically targeting non-residents or foreign-owned legal entities. In summary, the attractiveness of havens lies in their ability to provide a conducive environment for tax evasion or avoidance, underscored by secrecy and advantageous tax policies for foreign entities. In conclusion to this section, and as quoted by the briefing paper, there does not exist a single unambiguous definition of a tax haven or an OFC. Some regulatory criteria such as secrecy and low or zero taxes appear in one form or another in each definition. However, the lists of tax havens or offshore financial centers are based on different methods and indicators to identify such jurisdictions, end quote. In July 2017, the CORPNET group at the University of Amsterdam adopted a quantitative approach to assess tax havens, disregarding any specific definition, and instead analyzing 98 million global corporate connections in the Orbis database. The methodology involved using a variation of the technique employed in the International Monetary Fund's 2007 Offshore Financial Center working paper. The jurisdictions were ranked based on a scale of international corporate connections relative to local economic connections. CORPNET further categorized the resulting OFCs into two types: sink jurisdictions, acting as endpoints for corporate connections, and conduit jurisdictions, functioning as nodes for corporate connections. The study by CORPNET on conduit and sink OFCs led to the reclassification of offshore financial centers into the following two groups. 24 sink OFCs. These jurisdictions experience a disproportionate outflow of value from their economic systems, resembling the traditional tax havens that are known for these characteristics. 5 conduit OFCs. These jurisdictions witness a disproportionate inflow of value, as they serve as intermediaries for redirecting funds towards sink OFCs. They represent the modern corporate tax havens. The identified conduit OFCs are the Netherlands, the United Kingdom, Switzerland, Singapore, and Ireland. In the context of the study, sink OFCs heavily rely on conduit OFCs to reroute funds from high-tax regions, facilitated by the base erosion and profit shifting, or known as BEPS, tools that are incorporated and acknowledged within the conduit OFCs' extensive networks of bilateral tax treaties. Due to their association with traditional tax havens, sink OFCs usually and typically possess more limited access to treaty networks. Before closing off this video, I thought it would be fair and worthwhile to show you what the IMF Working Paper of 2007 lists as recognized and accepted offshore financial centers, which is now being shown. Thank you for watching this video until the end. This is truly appreciated by me, and I hope it provided you with valuable information, insights, and key takeaways. As always, I will be posting frequent and insightful content, so feel free to come back to the channel to stay updated on top of what is happening in the offshore global and financial services industries. Stay safe and healthy, guys. I'll see you in the next one. Cheers.